Hey everyone, welcome to a new episode of Trader's Den. In the last video, we saw the backtest results based on a random signal. If you haven't watched it, check it out first. Just to recap, we used a random number generator to go short when the number is odd and go long when the number is even. We saw how the random seed 42 generated decent results, but changing the seed or skipping the first few numbers changed the results drastically. Before we dive in, just a quick heads up, pause the video now and take a moment to read the disclaimer. Let's look at the ensemble method. In simpler terms, instead of relying on a single coin flip, you flip 100 coins, and then you go with the majority vote. The idea is to find a stronger consensus within the randomness. But does taking a vote actually work? Let's look into the system again. First, we create 100 random number generators, seeded from 1 to 100. Next, for each trade and for each random number generator, generate the random number and the signal using the same logic. An odd number is a short signal and an even number is a long signal. Then, take a majority vote and use that as a signal. Therefore, with 100 random number generators, if we have 60 short signals and 40 long signals, we will use short as the signal. In some cases, we may get equal votes for both the long and the short signal. In that case, we will not take the trade. We're backtesting this on the NQE mini futures using 1-minute data all the way from 2008 to 2025. And these are strictly day trades. We get in right at the market open and we're out by the close. We have assumed the costs of trading based on retail trades. However, because the date range is large, assumptions for the past costs may be slightly inaccurate. When I refer to TP equals 50 points, that is valid when NQ is at 20,000. That is 0.25 percentage points, and those are rounded up in the backtest. So if NQ is at 21,000, TP equals 52.5, which is rounded up to 53 points. But to avoid confusion, whenever I refer to take profit or stop loss equals 50, assume that it is based on a percentage points. And therefore the actual stop or take profit points will differ based on the entry price. In part 1 of this experiment, we saw that letting the winners run was our best choice. So we will not set the take profit in this case. Remember that these are intraday only trades, and therefore will close at the end of the day. In the first case, we use the stop as 100 points, and the take profit is not set. The win rate is surprisingly just above 39%, and we see an upward moving profit curve. In the following case, we increase the size of the ensemble. So, instead of using 100 random number generators, we use 1000 random number generators to take a vote. The win rate is above 38%, and we still see an upward moving profit curve. However, the profit curve is not as smooth as earlier. Let us try to tighten the stop. This one has a stop of 50 points. And we will test with an ensemble size of 100. It reduced the win rate to 26%. However, the profit curve remains upward, albeit with larger drawdown periods. But is this just the reward-risk magic? Let us go back to our first test with a stop at 100 points. What if we reverse the signal? Will it give the same performance? Well, it could have been. But it doesn't seem to be just the reward-risk magic only. What if we skip a few signals? Like we did in part 1 of this experiment. We continue with a stop at 100 points, and the take profit is not set. First, we skip the first 10 signals. Here, we skip the first 100 signals. And finally, here is the result when we skip the first 1000 signals. Well, that was interesting. Let us try increasing the ensemble size to 10,000. We are not skipping signals now. Increasing the size doesn't help as much. Let us look at the probabilities. The probability of short is just the opposite of the long. First, we will examine it for an ensemble size of 100. This is the chart of long versus short probabilities with an ensemble size of 100. Next, let us see the probabilities with an ensemble size of 10,000. With a larger ensemble size, we observe spikes in the probabilities, but the range of these spikes is very small compared to the smaller ensemble. Can we filter out the noise and backtest the results on the higher ensembles? When we increase the ensemble size to 10,000, the probabilities cluster tightly around 50%. One standard deviation is just 0.5%. That means 68% of the time, the long probability stays between 49.5 and 50.5. 95% of the time, it's between 49 and 51. And almost all the time, it's within 48.5 to 51.5. This shows us that most of the movement near 50 is just noise. To filter out this noise, we only take signals when the long probability actually touches or breaches the extremes, 48.5 or 51.5. That way, we ignore the noise in the middle and only act when there's a statistically meaningful deviation. On this chart, the black line shows the raw probability series, and the red and green dots show the filtered signals we would trade on. Let's see what happens when we do that. Here we see the backtest results when we only take signals at the extreme edges, 48.5 and 51.5. Notice how the equity curve stays relatively flat for long periods, but then catches a few strong moves. This strategy produces fewer trades, but each one, hypothetically, has more statistical significance. It cuts out most of the noise, though the growth is slower and more selective. Now compare that with a slightly looser range, 49 to 51. Here, the system trades far more frequently. The equity curve rises much faster, but also becomes more volatile. You can see strong gains in the middle years, followed by a sharp drawdown. This shows that by relaxing the thresholds, we pick up more signals, but also allow more noise into the system. It may seem like there is an edge with the filtering, or without it, but it's not. The underlying signal is random, and therefore, the win expectancy is going to be 50%. The range filter is a trade frequency filter, not a predictive edge. Without a real signal inside the generators, there's nothing to exploit. It's just data snooping if you see an edge in backtest. The in-sample profit slope may not align with out-of-sample tests. In the entire exercise, I did not split the data into train, validation, and test datasets, and it is easy to see why we could be experiencing overfitting. But here's the bigger question: what if the underlying signal isn't purely random? By pure randomness, we mean no hidden structure at all, just coin flip noise. But markets rarely behave that way. There are patterns, biases, and structures, even if they're buried under layers of noise. And that's the puzzle we traders are really trying to solve, finding signal inside the noise. If you found this video helpful, give it a like and smash that subscribe button. It's the simplest way to earn some instant karma. And hey, we'd love to hear from you. Drop your thoughts, questions, or feedback in the comments below.